Hey everyone, and welcome back to the channel. In today's video, we're going to be looking at how to estimate the downside risk of a stock. And this is something that's super important if you're going to be a successful long-term investor, because it'll be the difference between you making some really great returns and then some massive losses, or if you're going to be someone who is going to consistently make a satisfactory return and therefore actually compound your portfolio over the long term. So in this, we're going to get into what is downside risk, why it's important. We're going to talk about some of the different types of companies that have a high downside risk, just intrinsic in their type of business, and some of the businesses that traditionally have low downside risk. And finally, we'll talk about how you can assess downside risk and what is the ultimate protection against downside risk. So that is what you've got to look forward to in today's video. Make sure you leave a like if you enjoy it, and let me know your thoughts on this video down in the comment section below. But for now, let's jump into it. So I just want to start by explaining what downside risk is and what do I mean by it when I'm talking about downside risk in this video. And essentially, I'm talking about the worst case scenario of a stock. What is the worst thing that could happen? Or even not even just the worst case scenario, but what could happen if the company doesn't perform as we expect it to, or as analysts are expecting it to? What is the downside? What is the potential losses that we could experience from an investment in this business? And this is super important. And it's super important for a number of different reasons. The first point is that we need to make sure that we're investing objectively. We don't want to be making subjective investments. We want to make sure that we're looking objectively at what is happening within a business. And if we're looking objectively at what is happening within a business, then rationally we know that there is a field of possibilities for the future outcome of a business. It isn't just that it could go one way or the other way. It's a probability field. It might have a 50% chance of going up at a 5% rate, but it also might have a 20% chance of going bankrupt. It's a field of possibilities, any of which could happen, but each of which has a different probability. And to just ignore the downside and only to focus on the potential possibility of an upside in a business is seriously dangerous when investing. Because you could easily make an upside case for almost any stock. And that upside case might be fantastic. It might mean that you make 10x over the next 10 years. But if the probability of that happening is very low, and also within that business there is a high probability of the company going bankrupt, then you need to realize that there is a high chance that you're going to lose a lot of your money. And if you just focused on that tiny small percentage chance that the company blows up and becomes a massive success, then you're going to consistently lose money in the market, and you're not going to understand why. You're going to consistently think that you know how to analyze a business when you're really not looking at what is the high probability chance that the company is going to lose you money, if not all of your money. The next reason why it's super important is that looking at the downside protects you against confirmation bias. Now, confirmation bias is essentially where if you have an opinion about a particular business, then you're going to be subconsciously seeking out information that supports your contention. So when you're looking through Google, looking at articles, if you already have in your head an idea that this stock is going to be fantastic over the long term, then subconsciously you're going to be clicking on articles that are in favor of that stock going up massively in the future. And you're going to be avoiding articles that make compelling cases that the stock may go down over the long term. So now let's talk about what types of companies intrinsically have a high downside risk baked into them, because there's certain types of businesses that just always come with a higher than average downside risk. And one of these types of businesses is a business that has a lot of debt. Companies that have a lot of debt have high interest payments that are always burdening their business. And not only that, these businesses have borrowed from their future self. So those businesses need to come up with significant amounts of free cash in order to pay off those future debt payments that are coming down the road. And those looming debt payments intrinsically give a business a higher downside risk than one that doesn't have any debt. Another type of business is a new business, a business that has just recently IPO'd, maybe in the last 5 years. And the reason why these have high downside risk is because we don't have any financial credibility to look on in this company. There's no financial data. There's only a couple of years of data that we have available. We don't have a long 10, 20, 30-year track record of consistently producing cash flow for their owners. And for that reason, when we project cash flows into the future, those future cash flow predictions are very uncertain because we don't have anything to base it on from their past performance. And the final category of businesses that have high downside risk are high growth companies. So these high growth companies traditionally will have a high PE. They'll be priced very high relative to their current earnings. And the reason that they're priced so high to their current earnings is because investors expect their earnings to go up massively in the future. And the problem with that is that if they miss those expectations, even slightly, that PE ratio can come down significantly really quickly. And this means that if you're investing in a business that has a high PE and that has high expectations of high growth, then they need to hit those expectations in order for you to make any money. And if they don't, it's very likely that you will lose some, if not all of your money. So to flip the script, what kind of businesses traditionally have low downside risk? And it's basically the opposite of all of those things that I just mentioned. The first one is debt. Companies that have low or no debt have less downside risk than companies that have huge amounts of debt. And it's very obvious. If you don't have any debt, you can't go bankrupt. You might not be profitable, but if you don't owe any money to anybody, then you can't go bankrupt and you don't have those interest payments that are increasing your expenses and those future debt payments that you need to pay down. And this is why I personally always look for companies that have very low levels of debt, because I just want to eliminate the possibility that the company goes bankrupt. I don't want that to be a possibility in my investments. And that means that my return on investment will be entirely down to the profitability of the company. And I cannot worry about the company going bankrupt because they mismanage their debt. And the second type of business that often has low downside risk is old and big companies. Companies that have been around for a very long time. They have consistent track record of earnings, stable earnings. So this isn't all old and big businesses, but there are many old and big businesses that have consistent earnings over a very long period of time. They're a huge company that has a huge branding moat or some other kind of moat around them that is protecting their earnings. And these kinds of businesses are much less likely to lose you money over the long term, and therefore they have significantly less downside than other newer high debt companies that are on the market. So how do we assess this downside? How do we analyze it and understand what the magnitude of the downside is and the probability of that downside occurring? So the first thing that you want to do is you need to make a really strong case for the downside of that company. Now, the downside in a company that has a huge amount of debt is bankruptcy. It's that you lose all of your money because they don't produce enough cash flow to make those debt payments. And that's a real possibility in a lot of really big companies at the moment, Tesla. And I don't think a lot of people are really appreciating the weight of that debt on a company like Tesla. So one of the questions that you might ask is that, what would my company look like? What would the value of this business look like if it stopped growing at the rate that it was growing? So let's say you have a company that's growing at 10% per year for the past 10 years. Well, one of the downside possibilities is that they just no longer grow. So their earnings just stay flat for the next 10 years. What would that look like? Would you lose money on your investment because the PE would come down and you would lose money? Or is it at a low price to earnings that you wouldn't actually lose any money and that you would still make a decent return? These are the kinds of questions that you've got to ask, and you really need to just make a case for the downside. What would happen to my investment if this happened, and am I okay with the outcome of that? So just to wrap this video up, I just want to explain what my ultimate downside protection is. And it really comes in 3 words, and I'm sure many of you know them. Margin of safety. Buying businesses below what you think they're worth. And I'll break this down for you. What you think that a business is worth is based on your future projections of a stock, and it's generally in the same ballpark as what other people are expecting a business to perform at. And if you pay that value, then there is a chance that if your case for that stock is wrong, that you're going to lose money. But if you wait for a 50% or 30% margin of safety where you're buying the stock below what it's worth, then even if the business does stop growing after it's been growing at 10% per year, you won't lose money. You will just make a smaller return than you expected. And that is a much better downside than actually losing money in the market. Whenever I'm calculating intrinsic value, I like to calculate intrinsic value within a range. And the bottom end of the range is generally a pretty likely worst case scenario that could occur. It's not, I usually don't estimate that a company's earnings will go down significantly, but I will, if I have a company that has been growing at 8 to 12% per year consistently, then maybe the downside, that's a very likely outcome, something that could happen, but I don't expect to happen, is that it just doesn't grow anymore for the next 10 years. And I will look at that. And I want to see that I'm still going to make at least a little bit of money, or that I'm at least going to get my initial investment back if it massively underperforms what I expect. And if it does, then the upside is worth it, because the downside is I don't lose much and I make a little, and the upside is that I make a lot. And that is how you protect yourself against the downside risk of a stock. So I hope you guys enjoyed this one, just a short one today explaining how to assess the downside of a stock, as I think it's super important that people understand this, especially with how much hype there is around Tesla on YouTube at the moment. It's kind of ridiculous how many videos there are coming out about Tesla just because it gets views. I mean, I guess I can't really blame them. I did one as well, but I made the case against Tesla, so I feel like I stand out a little bit in that crowd. But yeah, I think it's important that we ground ourselves and don't get too carried away in the speculative investment space of the Teslas and all of these other businesses that have huge amounts of debt and no proven track record as of yet. But I hope you guys enjoyed this video, and if you did, of course, make sure you leave a like and let me know your thoughts down in the comment section below. But for now, guys, I'll see you in the next video.